cannot see at the same time when I post to you. I think that you may have this. Okay, so welcome to everybody for this international finance course. So this is a kind of the one more step advanced courses of corporate finance that I would try to reinforce and apply the fundamental of finance that we have learned together in an international setting. What international setting means, the issue that we're gonna address when a company has to do something called the cross-border transaction. The cross-border transaction, such as investment, financing that many of multinational corporations need to make in a way that they can also, invest in the country outside their home countries. So we're gonna focus a little bit on emerging markets. And you are in Vietnam, majority from Thailand. But what we're gonna do it, we're gonna use the practical case study from Harvard case study. The case is a little bit old, but it's still very interesting from my view. So therefore, I keep it for the Petro Suwata cases. Have you see or read these case? I gave it to you. Do you see all the material, including the case of Petro Suhata? Yes? Yes or no? Yes. Okay. So this case is not very long, but I think it's very helpful and useful for our discussion. Oops. Do you see my screen? Do I need to stop and share with the new one, or you can see the Petro Suota screen on your screen? Do you see Petro Suota case? Yes. Okay. So the one that we are talking about here is the case where I would like you to let me share with you one more time, where I'm gonna show you the case. So this is a case is about, okay, the case is about Petro Suota case. What is a Petro Suota case? The Petro Suota is an oil field project of 2.4 billion project, and we're gonna learn how this project is designed and how this joint venture between a company from emerging market in petro in the oil business of Venezuela called PDVSA, and the DuPont, which is the another investor who planning to invest in this project in Venezuela. Okay, so the PDVSA and Conoco are the major sponsors. Major sponsor means the owners of equity holder of this project. All right. So this is a case where I found it super interesting, and I would like to take this course as a course of that linked or related to the real world as much as possible, so that we can share, we can discuss, we can brainstorm on some of the complicated questions that we have to simplify and address it properly. For the end of the day, we would like to know whether you're gonna do what if you are the equity holder, if you are the shareholder of DuPont or Conoco, or if you are the credit rating agency, you're gonna give the investment grade or not, and so on and so forth. There are some many interesting advanced questions that need to get a simple answers. Okay, so That's what we're gonna planning to do. Okay, we're planning to do the analyze through this Petro Suata 2.4 oil field project in Venezuela as a case study, where this project has two project sponsors, Conoco and PDVSA. They're planning to, meet the development agency in Washington, D.C. and New York City to meet the rating agencies. Okay. So they're planning to raise 1.5 billion debt in capital market, meaning that they're gonna planning to issue bonds. The interesting thing about this one, since the project in Venezuela, and where the Venezuela got lower investment grade rating level. However, they believe that the project is strong, the project is economically strong, and then they should try to convince the rating agency to get an investment grade rating. Everybody know what is an investment grade rating means? What is the minimum of investment grade rating? Anyone? Anyone know what is the investment grade rating? What is investment grade rating means? We have 32 people now. Excellent. Everybody know, I will try to make it very interaction and discussion. So please be active in the chat. Or if you want to speak, I can allow you to speak. But this course cannot be, you know, very helpful if you don't participate, you don't, think along with me. Okay. Obviously, the investment grade rating are the bond that got the rating above certain level. Okay, example, triple A by S&P, AAA, and so on. So, Tan Gung Tan, the grade C is lowest. No. What is the what we call investment grading line? The investment grading line, you see that the bonds can got different rating, starting from the triple A minus, the double A plus, double A minus, and so on and so forth. So what is the line where we consider that bond got the rating above this investment grade line? We called it as investment grading bond. What the bond that got lower than this line, we call what? We call high yield bond or speculative bond. In the past, we call the junk bonds. Okay, so the line that we used, or the one that we use, is the triple B, triple B minus, right? All the bond got rated above this line, we call investment grading bond. Even lower than this line, we call the speculative bond, or we call junk bonds. Okay, this is good or bad to invest in the junk bond, in the speculative, or we call high yield bond. Is good or bad? Good. Is good or bad to invest in a bond which got the lower than investment grade rating? Is good or bad? If you don't know, I say what? If you don't know the answer, you say it. It depends. It cannot be bad. It cannot be good. It just simply what? It just simply represent the risk level. Okay, when you are lower than investment grade, we consider that a risky bond, because as I told you in the capital structure class, the risk is relative, right? So if the risk is relative, investing in high yield bond or lower bond rating, meaning that you're gonna get a higher yield from investing that bond. When you invest in triple A, obviously you cannot say good or bad because the bond is less risky, but the return to investor investing in the triple A will get much lower return than you investor who invest in C bond. That makes sense? Makes sense to you guys? Yeah. So the interesting thing that we would like to use and discuss in this case is that the Venezuela, okay, for example, if you are the what Wincom company, a Win Group, okay, when you go international, okay, this is how you can get it on Appendix 9, Exhibit number 9. So above these investment grade, we call investment grade, and lower than this, we call high yield or non-investment grade, okay? So this one, they don't have plus or minus, but it's just only to get your rough idea. But what you can see here that at that time in 1994, 1996, I think that is not changed that much. The Venezuelan sovereign bond, everybody know what the sovereign bond means? Got the rating of B, okay, and 1996, which is B is a high yield bond or the investment grade bond. Everybody know what is a sovereign bond? What is a sovereign bond? Everybody know what's a sovereign bond? It's just the bond that issued by the government, okay? In the international market, usually you have government bond issue locally, but you can have also bond that often issue in US dollar and sell to the international investors. So, and this one we call sovereign bond, okay? The sovereign bond of Venezuela, it means the Venezuelan government borrowed the money from the capital market, and the bond rating agency rated the Venezuelan government credit rating as the B in 1996. It means lower than the US, who got the triple A, Canada is double A plus, Mexico double B. That it says something. It says that it's good or bad to invest in Venezuela sovereign bond as compared to the US bond. Good or bad? No, you cannot say good or bad to invest in Venezuelan sovereign bond. The answer would be, please, the answer would be depends. It cannot say bad or good. We just simply that the risk that you're gonna take as the bond holder when you buy sovereign bond of Venezuela, you hold a bond with the B rating, where therefore you would like to know whether or not this B rating, what the yield you're gonna receive or return from investing in that particular bond. Okay, most of the time when we're talking about sovereign bond, we refer to a government issue bond in US dollar so that to the international or make it available to international investors. Okay, so foreign exchange risk is somehow already uh, um, incorporated where most of those government promise that they're gonna pay to the US dollar bond or sovereign bond investor in US dollars. Okay, that is the kind of common that when you investor invest in US dollar, even it's issued by the Vietnamese government, the Vietnamese government take responsibility to pay investors to pay investor the bond coupons and the face value in US dollar. So the foreign exchange is foreign exchange risk is direct foreign exchange risk is belong to the Vietnamese government, not the investors. Okay, except that when the government uh, who don't have capacity to convert it in US dollars, so therefore you're gonna have also a higher indirect risk of foreign exchange that translated into the high probability of default or default risk or the credit risk become higher in a country where the foreign exchange risk is higher. So far, so good. You follow a little bit my discussion. Okay. So let's go back to Petro Suata case. The Petro Suata case, and they have only, I would, ask you to read the case maybe tonight or tomorrow before the class to get, they have around 10 pages. Okay. It's not very long. Please read it, okay, so that we can, discuss, because you can see you have a lot of elements that we can discuss in this a very interesting international financing arrangement that we can learn from this one. Okay, you can see that from page 1, 2, and 3 is a lot of blah 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 on who are they, the PDVSA, what is Venezuela, what is Conoco, and then starting from page number 4, we're talking about this Petro Suata project. Okay, the the challenge that I would like you to do is after reading, you're gonna try to, prepare and answer this type of questions. Okay. First, what are the costs and benefit of using these project finance instead of traditional internal debt finance? Second, what are PetroSuota's 3 or 4 most important project risks? How does the deal structure address those risks? And who would bear the risk if the project financed internally instead of, PDVSA internal debt financing? What kind of debt? The agency debt, bank debt, Rule 144A bond market. These are the 3 type of debt that the project, the company planning to do. And what are the advantages and disadvantages of each kind of debt? Will the bonds get an investment grade rating? So you're gonna play in the form of, if you are S&P, are you going to give the bond rating of triple B minus minimum, or you said no, I won't give it. But if you want to get the investment grade, how can the project improve the probability of getting an investment grade rating? Okay, investment grade. Would you invest equity capital as Conoco? So if you are the shareholder of Conoco, are you going to invest in this project or not? If yes, why? If no, why? You see the questions look simple, but it's not that simple to answer. And then we're gonna try to use all those theories that we have learned in capital structure to try to answer this question in a more, reliable way or more convincing ways. Okay, we're gonna make some calculation together. We're gonna use some logic to discuss about these as the debt holder and as also equity holders. Hey, so far so good. I come back and try to see you. So, any question? So, this course, the evaluation will be completely different from the previous one. So, at the end of by Sunday, I think that the last one we're gonna meet together, I can give you some small quiz of what we discussed in the class, and then you just give this quiz the answer, very short and simple. No need to do a lot of, exercise, homework to be able to fulfill this. You just come to the class and get all the lecture I give, and then you follow what we discuss. Everything should be all right. Okay? And the grade should be easily contributed in a very simple way, okay, based on your participation, your discussion, and some small quiz. That makes sense? Yes. Perfect. So you follow what I discussed. I would like you to follow, so you can even you are even better if you read the case, and then we can discuss a little bit more. But each time I'm gonna give you some guideline that make our discussion uh, richer. Okay, so let's come back to the syllabus. That what we want to do. What I would like to share with you on the class that we're gonna do it together. So this class is about more on the view of investment bankers. So everybody know what is investment bankers, right? The consulting, you can be also multinational corporations where you invest or you have the cross-border investment projects. So somebody have been already, I saw from the chart that, okay, it depend on foreign exchange. We're gonna introduce you a little bit what is the foreign exchange is about, what is the foreign exchange risk, and we're gonna learn some, international parity relationship, try to understand why the interest rate would affect the foreign exchange, uh, you know, um, um, the spot rate, what are the how did affect to the the forward rate, and what are the forward rates. I think you have taken some courses in derivatives already. So and then I'm gonna talk. That is a kind of first module on the international parity relationships. These are the relationship that I give you some exercise or problem set that we're gonna work it together during the class. And the more important one is about cases where we're gonna use the case to explain, to discuss with you on international debt financing and international equity financing. In the case of Venezuela, they are going to issue the international bond in the US. Okay, we call 144A market bond. This is how they do international debt financing. So if you are working for the Vietnamese company and you are planning to issue bond in New York City, this is how this project is about. Okay, so and then we talking about international equity financing. So if you are investor on in the US, you are planning to invest it in Venezuela, and how you can incorporate some of those risk. But right now, it's just only the domestic risk or the risk related to the project, but you have also the cross-border related risk. Okay, and if you are investors, how you can incorporate those kind of cross-border related risk into account. For example, political risk. Okay, how you address, and then we're gonna use the case to do so. So the project assignment and case discussion will be a kind of major one with some relationship calculation from problem set. And together, I'm gonna give you a short, like 30 minutes quiz to do it during the end of the session of on Sunday. I hope everybody can come on Sunday. I think that is the last one that we can have. Uh, Wednesday, Thursday, Friday, Saturday, and Sunday, if I'm not wrong. Okay, any question before I go to the first module on Introduction to International Finance? So far, so good. Sorry, may I ask, the exam will be on Sunday. It's not the exam, it's a kind of quiz. So, do I have a class on Sunday? Let me check. Probably the last one. I don't know when is the last one. Yeah, I think we have. Yeah, I have last class on Sunday 17, if I'm not wrong. In the morning in Paris time, I think in the afternoon for your time. Any problem? When we discuss the case tomorrow, we start to discuss tomorrow. I have some this probably starting from Friday. Friday onward, we can start to talk about the case. I will not just simply ask you to go one by one, but what I'm trying to do is I'm gonna bring the perspective on the case, and I'm going to discuss for some element of the design of the case to understand the bond issuance and to understand the equity part investment and so on and so forth. So I will not just simply go to now we discuss about the case will be integrated in my discussion. So therefore, starting from Friday, you should absolutely read that case study, okay, beforehand. Small quiz. I don't know how many question I will see, but I would try to make it short. Okay. So how long does it take? I don't know, maybe 15 minutes, 20 minutes. I see how we can organize it because I have to put it, and I can probably ask you to submit how. I don't know yet. So let me work out with the CFVG team to see how to implement it, the assessment of the class. Okay, um, from the quiz. I forgot how did I do it last time. Okay, I tell you more. Tomorrow or after tomorrow. Just only try to make it on Sunday to be with me. Yeah, good. So let me continue and follow the first introduction for today. Okay. I will discuss later on, do these case of bond issuance could be applied to green bonds? Obviously, okay? It depends on whether the green bond will issue in the US, because we are talking about particular bond market we call R144A market, where the international issuers issue bonds in the US. Obviously, you can issue green bonds, you can issue project bonds, you can issue sovereign bonds, you can issue several type of bonds. I can explain, or when you read the case, you can understand what the R144A market, bond markets look like. Okay, it's a particular bond market that allow international issuer to issue bond in US dollar in New York, right? In the US. Okay, but you have any other bond market to issue? Do you want to issue in Europe, in London, and other? But what we are talking about here, we're talking about R144A market, which is a particular market that allow international issuers to issue bonds. Okay, so, oops, perfect. Okay, you see my slide? And slideshow. Let's show this one. Uh, Okay, so what is international finance? Okay, what's special about international finance? The probably 4 or 5 issue that we can discuss. The first one is obviously when you do the international finance, meaning that you do the cross-border transaction. Cross-border transactions, obviously, if you have from one country, you invest in another countries, if the currency of the transaction is different, so you are, subject to something called the foreign exchange risk. Also, you have the situation where the risk of a country may be different from another countries in terms of political situation, economic condition, macroeconomic things, and those are something called the political risk and other risks related to those cross-border transactions. And there are also the issues that we need to discuss about that some country may have very high inflation rate, may have some also crisis, and then but they also have the benefits that you can get from the perspective of international investors. And also the information and control may be different when you invested in firms that have different ownership structure and the governance structures. Okay, so let me talk first on foreign exchange. I hope that you have done some international or foreign exchange. Did you have a course on international or foreign exchange so that I can see whether I can go faster or is something completely new for you guys? Do you have any course related to forex? Have you seen any forex related issues? Have you done any forex in other class? We learn a bit in some courses. No, sir. Okay, let's take it as the something that I can introduce to you. Okay, even though it's not the main part, I can evaluate you, but I think it's good to review a little bit on it. Okay, so the risk that occur when firm, individual, or government are engaged in cross-border transactions. You understand what the cross-border transaction means? So the risk that foreign currency profit may evaporate in dollar. Assume that we are now you are the U.S. investors to simplify thing. So you are the US investor, your home currency is US dollars, and you are anticipating or you are working or you are evaluating or foreign exchange rates from perspective of the US investors in majority of the discussion we have. So let's assume that you convert $1 equal to 85 yen. Everybody know yen? Yes, it's Japanese currency. And then you invest the $1,000 to buy 10 shares of Toyota, which is $100 per share. So you're gonna have 85,000 yen. 1 year later, the investment in worth 10% more in yen. So your investment grows from 85,000 yen to 93,500. Okay. And if the yen has depreciated means the value is down. Okay, so $1 equal to 85 yen. When $1 go to 100 yen, is mean yen is depreciated. Dollar is what? Dollar is appreciated, right? So, uh, all right. So if you have dollar, which is appreciated and yen depreciated, so after your investment, 1 year later, your value of your investment grows from 85,000 yen. At the beginning of the year, you converted of your $1,000 at the rate of 85 yen equal to $1. So if the yen has depreciated to $1 200 yen, you can convert it 93,500, which is your yen investment amount, okay, will be converted to the amount of $935. So therefore, you actually lost money of $65 in dollar term, even though your yen term is increasing. So therefore, this one we call the foreign exchange risk. Okay, so we kind of come back later on tomorrow on how the value or the foreign exchange rate can go up and go down. What are potential factors that may drive or explain the value that go up and go down? Okay, in the form of international parities. Now I'm talking about political risk. The political risk, okay, this is also another important factor for international finance because the sovereign government have the right to regulate the movement of goods, movement of capital, and movement of people across their borders. So therefore, the government has power, the power to change the rule of the game and sometimes in unexpected way. And these political risks, we are not talking about the geopolitics extreme cases where we have something at the moment of Russian and Ukraine. That is a kind of extreme cases where we really have those problems. But even in the more regular time, you have also the government who may change the rule of the game. They may change the tax rate, they may change royalty rates, and so on and so forth. That they promise to international investor that if you come and work in these industrial park, you don't need to pay tax for how many years, and then you need to You don't need to pay anything else. We're gonna provide all those. Please come and invest in our countries. Okay. However, when you change the government, sometimes these privileges or tax treatment may be, may not hold when the government change. Okay, and therefore this one is part of what we call the political risk. Okay, so sometime also investment in emerging market economy. Many countries are those without a traditional rule of law. Law exists but poorly enforced. Some extreme cases, some government may direct expropriate by nationalizing the privately owned assets. Okay, and this asset belong to a company, and tomorrow the government said this belong to the government, and that's what we call direct expropriation. This is the kind of extreme cases of political risk. All right. So now we have also an issues, and when you discuss about international finance, obviously we know that in the existing system that the currencies are traded or determined, and these kind of regime where countries manage, particularly the central government who manage the currency, who monitor the currency. Some of them, some government use the what we call the picking, all currency board or the picking system that allow the government to fix what would be the rate of the local currency against the foreign currencies, right? So other majority of the country, they don't use this kind of currency pegging or currency fixed rate regime, but they use the floating regime and let simply the market to determine what would be the value of US dollar, what would be the value of Swiss franc, what would be the value um, of euro against other currencies. Okay, and let the market determine. Where some country like Vietnamese dong is still fixed or float. What is the system regime of the Vietnamese dong? Is it fixed or is it float? Maybe it's already changed many years already. Have not been in Vietnam. You still open? Is the country's open for visitor? Can I go to teach in Vietnam? Can I? Are we still in the COVID? We open from 15th of March. Very good. So maybe I may be able to travel to Vietnam one more time, and also to meet you guys. Okay. So let's come back to Vietnamese dong. Okay, the Vietnamese dong is, we can consider as what we call the managed float, but it's very close to fixed, right? So it is the government who determine what the range of the reference rate, and then the market will use that central rate to trade a little bit around that central rate. Is it right? So this one we called it as the managed float, or almost fixed, right? But because the government still the main person who determine what would be the rate where the US dollar, the Federal Reserve, which is the central bank of US government, cannot determine However, they can interfere because the central bank, like the European Euro, you have European Central Bank, they are the big player in the foreign exchange market where euro are traded. So therefore, if they believe that the US euro is too strong or too weak, they can participate, they can heavily buy or sell the euro in the market, and the central banks play a very big role in those markets to ensure that there is a kind of stability of the currencies where they manage. Okay. Okay. Just today is a kind of introduction, and I would like to introduce you some of the context, and then they have a very the risk of high inflation in some emerging country, particularly the Latin America, and then we know that after pandemic, the inflation rate is become a very important factors in the economy in around the world. But if you take some particular countries like a Latin American country, the inflation can be 2 digits and become very important issues for the currency. Okay, we're gonna discuss about how the inflation and interest rate affect the foreign currency tomorrow. Okay. And then obviously you may heard about the the crisis. The crisis happened in emerging countries, such as in 1994 in Mexico. We call tequila crisis. We have also Southeast Asian in 1997, starting from Thailand. And then you have the Russian crisis at that time in 1998. Now you have another economic crisis in Ukraine, and likely also in Russia due to these geopolitical conflicts. All right. So the crisis that I would like to share with you to give you some ideas that that is proposed by Krugman in 1979. Krugman got the Nobel Prize and explained why a currency may experience speculative pressure that can lead to a crisis or devaluation when the currency is floating. So what's going on when you have the fixed rate regime? Okay, so I don't say anything good or bad, but I just want to say that if the government who manage the fixed rate or the currency don't manage well, you have the situation that it may happen to your currency. Okay, so the government follow policy inconsistent with the currency peg. Okay, what does this mean? It means like if you peg your Vietnamese dong to US dollar, which is let's say 20,000, but you keep this for a long time and you're not allowed to move, what happened if the value of the uh, the purchasing power or the inflation rate in Vietnam is much higher in the US? So normally the currency value should be the ratio of your currency that you can buy a basket of goods in one country divided by the value in local currency that you can use to pay to get the same basket. Okay, so that's why sometimes people use the price of Big Mac, and then you get the Big Mac price. Have you heard something about Big Mac price? So if you use the ratio of Big Mac, which is the kind of proxy of the price of the standard goods that you can buy in the US, as compared you can buy in Thailand, and then the ratio of the Big Mac price can be considered as the what we call the PPP price. We call purchasing power parity price of the US dollars and Thai baht. Okay, so everybody follows. So once you fix the currency, let's assume that you fix the Vietnamese dong at 20,000 Vietnamese dong equal to $1 this year. Let's assume that the inflation rate of the in Vietnam is 6%, where the value or inflation rate in the US is 2%. So you can see that the ratio of the currency, that normally if the Vietnamese economy, Vietnamese dong, has a higher inflation rate than the US, so what would gonna happen normally would be the effect on the value, the real value of the currency of Vietnamese dong. The Vietnamese dong should depreciate or should appreciate. Everybody follow me? You follow? Yes. So let's assume that inflation rate in Vietnam is 6%. Inflation rate in US dollar is 2%. So as I told you, the US dollars Vietnamese dong, okay, should affect from these different of purchasing power. In a country where inflation rate is high, meaning that you're gonna need more amount of Vietnamese dong to buy the same basket of goods. So normally the Vietnamese dong should depreciate or appreciate. Everybody follow my questions? So in the countries where the you're gonna have, so the value of Vietnamese dong should depreciate, okay? In the country where the inflation rate is higher than their counterpart, okay? So let's assume that the government um, keep the rate of Vietnamese dong. What is the rate of Vietnamese dong US dollar today? What is the rate of the Vietnamese dong? I'm not traveling for more than 3 years now. After the COVID, I miss Vietnam a lot, particularly Vietnamese food and Saigon beer. It's a joke. What is the Vietnamese dong? Is about 23,000. Okay, let's assume that 1 years ago or 5 years ago, if you keep Vietnamese dong, you fix it at 20,000. Okay, if you use the fixed rate and you don't adjust it and you keep it 20,000, okay, this is exactly what I explained here, that if you fix the currency, so your local currencies should overvalue or undervalue. If you fix 20,000, where probably the real value should be 23,000, so therefore Vietnamese dong is overvalued when you use this fixed rate regime. Very follows. Yeah. Perfect. If is overvalued, what happened? That happened to many countries, though you may have speculator who know that is when you hold the asset which is overvalued, or if you know that the Vietnamese dong is overvalued, what you're gonna do is you're gonna speculate. In this case, it's not easy to speculate because the Vietnamese government control, like the case of the um, of Chinese yuan, the central government still strictly prohibited for those speculative transaction, isn't it? So the let's assume that was happened in Thailand in 1996, 1995, or 1996, approximately at that time, where the Thai baht was fixed as 25 Thai baht equal to $1 for a long, long time. And then the government still use those fixed rate regime and keep it, stabilize it at 25 dollar 25 Thai baht equal to $1. So a lot of speculator come to attack the value of Thai baht. What they do is they you know they heavily sell Thai baht and buy US dollars. So this one often a speculative that you gonna sell your local currency and convert it to US dollar and run, right? Because this one you gonna get something overvalue. The central bank who gonna try to stabilize, they need to defend this peg. And then when the speculator want to sell Thai baht, want to sell local currency, and the central bank at that time, the Thai government also need to defend the value of Thai baht. What they can do is they can just simply, buy the Thai baht by US dollar delivery, right? So in that case, you defend, defend, defend. So you promise to pay US dollars, and then the country has a certain level of US dollar. They keep it in the foreign reserves. So until you achieve or you reach to the level where you cannot stand it anymore because you have too low US dollar reserves. So therefore they have to give up. When they give up, they have the crisis that happened in Thai baht was attacked in May 1997. The Bank of Thailand intervened heavily to support the Thai baht. And July 2nd, 1997, Thailand abandoned its exchange rate peg and allowed baht to float. Immediately, the contagion affects to other countries in the region because most of those countries, they also use the fixed rate regime like Thailand, where they do a small managed flows like the way they do it today in Vietnam, but Thailand was not anymore the managed float regime, but they are completely free floated. So what happened after Thailand abandoned its exchange rate peg or fixed it by the government, but they allow baht to float, and then therefore 25 Thai baht equal to $1. After one day, it's become like 45 baht equal to $1 after the July 2nd, 1997. Not just only in Thailand at that time, they have also Philippines, they have also Indonesian rupiah, Malaysian ringgit that have the same, exactly the same problem. Okay, that what we call the contagion effects that affect from one country, and the same problem can affect to another nearby countries. And then obviously when after the government, the central government gave up, the way you can solve the problem is to go and get the money from the IMF. The IMF is International Monetary Funds that allow a country to borrow US dollar and put in the reserve. All right. So during that bailout package and crisis, from June 1997 to September 1997, the currency declined against dollar about 34% in for Korean won, 37% for Thailand baht, and 38% for Philippines peso, and 40% for Malaysian ringgit, and 78% for Indonesian ringgit. Rupiah, sorry. So not just only they have a crisis of currency, but also they affect a lot on the banking sector. And then we have also the, you know, a crisis in banking at the same time. I don't have this is another one that is about Mexican crisis, where the Mexicans started to have a kind of political setback in 1994, and people lose confidence about the Mexican government. The government, the Mexican economy slipped into recession in late 1993. People lost confidence to keep Mexican peso. They have what we call the capital flight, and the peso devaluated a lot on December 22nd, 1994. The peso was allowed to float, and the currency collapse was immediately followed by collapse of banking system and the real economy, and the peso, interest rate rose to a high of 80% by March 1995, and then they have some contagion effect to Argentina, Brazil, and so on and so forth. So the currency contagion effect is an effect on the probability of a speculative attack, which seem from attack on other currencies, like the case of Mexico that go to Argentina and then go to Brazil, for example. Okay, so I'm talking about the general ideas on, the risk associated with a cross-border transaction, particularly when you do international finance in emerging markets, from the perspective of investor from developed countries. Okay, any question? So far, so good. Are you tired? Yes, no, but I'm tired. Not at all. Very good. Somebody tried to make it online and then you do something else. No? You want to show your webcam with me? Are you at home now? No, never. You don't want to show how you look like? Anyone want to show with me? Some people use mobile phone. You still drinking beer while listening me? We please. Haha. Okay. Next next time I gonna ask you to put the camera on. No? Lecture quite interesting. Same with previous one. Yes. Okay. So tomorrow, can you put the camera on? No? No, sir. We are studying. Okay. You're studying. I'm fine. But I want to see your picture. Can you put, any one of you can just to see whether it works. Anyone can put your picture, your camera on Canvas. I forgot how it works. Can you put camera? Anyone is ready to show me your physical image, your photo. Camera on, we are at home and look well. Okay. So anyone, I just want to check whether it works. Look not well, I know. That's why I ask. You look well, you look not well, but it works. It's just only one of you who feel like you are comfortable. We have to log out, then log in again to open camera. Okay, so we can do it next time. Ah, Tan Chung. Okay, I give one bonus point to Tan Chung. I note it down because you put camera on. Anyone want to have another bonus point? Can you put the camera on? Very good. Trung Hian Tran. Very good. So you're still at home? Yes. So can you speak? Can I ask you question and you can answer of your speaker? No? I have to allow you to to speak.
Hi, Professor.
Okay, you can talk. Perfect. Excellent. Good. I don't feel lonely. That's good. Sometimes
How
it's
are you?
very good. Thank
Yeah. How about the COVID there?
the COVID. We have around on average 150,000 per day.
100 and thousands. Wow.
No, 150,000.
Wow.
But
Oh.
everybody just live with it because the hospitalization rate is very low.
Mm, yeah.
So it becomes just only, get affected, but nothing, no effect. So if we just live with it, sometimes we have 200,000 and no one, get panic.
Yeah. Vietnam is now open. I think you can visit Vietnam. I think, and we
Really?
don't. Yeah, we don't need quarantine any days, so it's easy to join Vietnam.
Ah, okay. I heard Thailand also opened the country as well. So I will probably try to arrange my next trip to Vietnam so
Yeah.
that I can so
Yeah.
that I
We
can eat. I
we
can eat banh
really look
jiao. I love
forward
banh
for you.
jiao. Okay, I I have I need to go for a technical break for 2 minutes. I come back. Okay, I go to
Sure.
restroom.
Yeah. Thanks.
See you in 2 minutes. Hey, okay, I'm back. Everybody back? Yes. Okay. Do you hear me? Yes. Okay. So at least T Feng An, who make the camera on, she's not back yet. So I can see here. You see? Ah, she's back. Okay. So you see, when you put the camera on, I can see what you're doing. Okay, perfect. So let's go back to the slide that we're talking about. Okay, so this is about the financial crisis and some of the currency. This is an intro that I would like you to put it on. I would like you to familiar with, and then we gonna discuss how to quantify it, how we do it in the real world, how we incorporate political risk in a project, how we can affect to our decision, and so on and so forth. Okay, so therefore I'm gonna use these in a very concrete way when we do case study. Okay, so I do have some blah 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 to introduce to you. The next one is that, as you know, the financial market are has become more and more globalized, where you have the countries that allow open to investors to invest in their home countries, in particularly in financial markets, in equity markets, in the bond markets, and so on and so forth. Why international investors are interested in the other countries, okay, to do those kind of investment? Obviously, because if the correlation between your home countries and the um, the foreign country that you invest is low, it means that you can get those kind of diversification benefits, like the way we study in portfolios classes, where we know that diversification benefit can allow you to diversify idiosyncratic risk, and then if the correlation between US market and Vietnamese market are low, so therefore international investor or US investor can get benefit from these diversifications. Diversification benefit means they are relatively less correlated, meaning that you can construct the low risk portfolios, or you don't need to sacrifice your return, without increasing your risk, or as a given, returns, you can minimize your risk, and as a given risk, you can maximize your return. And this is we call the diversification benefits. And also, as you know, the currency future option, you have some innovation in financial markets that allow you to do some more and more sophisticated financial instrument to manage your risk. Okay, like we have the currency futures market, we have forward market, we have options market that allow you to manage your currency risk. Also, you have advanced technology that allow you to invest it outside your home country in a very much easier way than before. And then have also the kind of Eurobond market. Everybody know what is Eurobonds market? What is a Eurobonds market? Is a bond issue in euro? No. Anyone know what is a Eurobond market? What is a Eurobond? Anyone know what is a Eurobond? The Eurobond is a bond, pay one time at the end. No, that is we call the zero coupon bond, right? So you don't pay coupon at the regular period, but you pay only one shot on your face value at the end. We call it zero coupon bonds. What is a euro bond? So we are in the international context, right? It'd be something related to international transactions now is the bond market that allow you to do what? Anyone know what is a euro bond? What is a euro bond? It's a bond. No one knows? I'm surprised. To raise money to run corporation for creating jobs. No. Okay. That is too general answer. Sovereign bond? No. What is sovereign bond? The sovereign bond is a bond issued by a government. Okay, we call sovereign bond. Eurobond is a debt instrument that denominated in currency other than the home currency of the country and make it in which it issue. Oh, you copy from internet? Why it's so fast and very nice written? See, you get it from internet? That's good. I don't say anything bad to this. Okay, Eurobond is a debt instrument, is a bond that the issuer, issue bond denominated in other currency other than their home currency. For example, you are the Vietnamese dong, country. Your company want to issue US dollar bond, and this one we call Eurobond. Okay, or you can be a US company issue bond in Japanese yen. We also call Eurobond because Eurobond market exists even before the invention of euro. You know that the currency of euro is very new, right? So that some European country who decided to issue or to use a common currency which is called euro, right? But they can pay or they don't pay. It depends on the type of the Eurobond characteristics. Okay, so now let's also talking about the cross-border stock listing. So meaning that when you are, for example, the Italian company called Prada, instead of issue shares in Italy, in Milan Stock Exchange, which is the main market in Italy, you can issue bond outside your home country, and this one we call the foreign IPO or cross-border IPO, right? So you make the uh, shares of Prada. Everybody know Prada? Yes. What is the Prada? Anyone know Prada? Okay. Prada is not only bag, but the bag are those, and Prada is the luxury, goods company. So where is a kind of, like LVMH, like the Hermes, and so on, right? So all these are like luxury products, okay, where they sell, those luxury bags, okay. And instead of doing an IPO, everybody know IPO, right? It's the initial public offering, make shares. They can go internationally. So that's why this is our scope in our class. We call international finance, because they do the IPO. But have also the market. Anyone know Alibaba? Yes. Do you know Alibaba? Alibaba. Everybody know the Alibaba? Yes. Okay. So if you want to buy shares of Alibaba, Alibaba is a listed company, isn't it? If you want to invest in Alibaba shares, where you can get, where you can invest in Alibaba, where shares of Alibaba listed, where the shares of Alibaba listed? Are you sure in China? In the US? in New York Stock Exchange, and the market that allow foreign investors or foreign company to list equity, list shares equity in the US market, we call the ADR market. Okay, ADR market represent the American Depository Receipt, okay, which is the here, right? American Depository Receipt. So, for example, if let's check the price of Alibaba today, so that you can understand where they are listed. Oops, let me check where I can check. Let's go easy to uh, let me share with you. Okay, you can see my screen. My screen, I can have, let's go something simple like Yahoo Finance. And I want to get Alibaba. Alibaba, we call Baba. Okay, Baba is the symbol. Okay, so the Baba listed in particular section of New York Stock Exchange. Okay, right now they traded at 99.75 dollar. Okay, where the price move up around these 100 for quite a while, and this is the example of international IPO where the Chinese company make an IPO in the US, allow the US investor to trade their shares in this market. Okay, and this one we call the international IPO. But you have also some cases where some company can invest or can um, put or make it the shares available in other countries from their home countries. For example, I can have LVMH in France, but I have some of the share of LVMH outside the main stock market. They can make it available to US investor in New York Stock Exchange, and or they can make some shares available to a London Stock Exchange, and this one we call cross listing. You see the difference between cross listing and foreign IPO or cross border IPO, right? So the cross listing represent that share of one country. So like for example, you have Wincom, and some of the share of the Wincom are also cross listed in the US market or in London market. And this one we call the cross listing. Okay, for Alibaba is the specific cross-border IPO where the Chinese company make stock only available to the international or US investor in the US. Share are not traded in the local capital market. Okay, it is clear to you guys. How would a Chinese investor invest in Baba stocks? So any investors can go to the U.S. market and invest it in the shares listed in the U.S. Right? The U.S. investor allow any uh, uh, international investor in invest in the U.S. Right? So if you are the Chinese investor who want to invest in Baba stock, so you have to go to the US market and invest it in Alibaba stocks. Alibaba shares are not available in mainland China. Okay, so they have some Chinese company who did this way. Some of them, majority of them, or many big, large, many big Chinese company, they don't make shares available in US, but they did it where? In Hong Kong, right? You have Hong Kong Stock Exchange that allow mainland Chinese shares company to issue shares over there. Okay, some of them they also do some cross listing where some of the share are available in Shenzhen Stock Exchange and China Stock Exchange, and then they issue particular shares they call H shares and make it available or traded in Hong Kong Stock Exchange. And this one we call H shares, Hong Kong shares. Okay, when we're talking about H shares, often refer to mainland Chinese company that issue some shares available for international investors in Hong Kong Stock Exchange, right? Like the way of some company make some, share available in ADR market in New York Stock Exchange. It is clear to you guys? So, for example, you want to do like study the large, emerging markets. You want to know what are the big company in the emerging market in this world. You can probably take example of the emerging market index, and then when you can see, let's check. Let me check with you. If I take emerging market index, let's take it. You can see my navigation on my screen. Let's check it with you. Oops. Okay. So if I take the MSCI emerging market index, okay. So for example, okay, this is the performance of MSCI. Okay, do I see something? So these are Taiwan Semiconductor, Tencent Holding, and Samsung Electronic, Alibaba, Reliance, Infosys. This one they don't indicate. Let me check other things that I may find some interesting information for you guys. Um, how we call that one? The BRIC index. Do I have the BRIC index that show me some name of the company? Okay, I don't have it here. So these are the main company, but they don't show where they, okay, let me check. Mm, okay, do I see something? Oops, let me, okay, let's go. Okay, let's go for, do I see something here? Okay, no, I don't see it. Okay. Do I see something? Ah, okay, this one. Good. Um, Everybody can see this one. Can you see my screen of S&P Emerging Market Index? Everybody can see here or not? Can you just answer me? Can you put it on the chat? Do you see it? So I can see, okay, okay, you can see now. You don't see now because I just close it. So I can send you, I can put it on the convert later on. If I take these emerging BFI, so you can just have a look here. You can see these are the big company from uh, emerging markets, and you can see Tencent Holding, Alibaba Group Holding, ADR, meaning that this company is listed in New York. And then you see Taiwan Semiconductor Manufacturing that is listed in Taiwan Stock Exchange, Taipei Stock Exchange, China Construction Bank Corp, H shares. You can see H share here. These are the shares that traded in Hong Kong. Okay, obviously China Construction Bank are also traded in Shanghai Stock Exchange, but this one we're just talking about the shares that available to international investors. Same for Industrial Commercial Bank of China, H share Baidu. You know how Baidu? Yes, it's a competitor of Alibaba. You can see that they are traded also in ADR. Bank of China is also H shares. Okay, you understand now what the ADR means, what the H share means. Yeah. So this is just only to give you some practical information. So I can put it in the convert um, file that allow you to get some more document here. Okay, so I upload it later on. Oh, I can upload it now. So I can have my teaching FHG 2000 this reference. I have the BFI. That normally you should have these on your platform. Okay, so let's come back to our business. So I going to talk a little bit about the later on the benefit of having international investment diversification benefit. So me show you some interesting graph, okay? And I would like you to help me what you observe from this graph, okay? So, oops, everybody see this graph. The graph is a little bit old, but I put some new graph that is closer to the real, more recent one. This is a graph that show about the MSCI emerging market and Dow Jones industry average. So everybody know what Dow Jones, right? The Dow Jones is what is Dow Jones? Hello, you're sleeping? What is Dow Jones? Everybody know what is Dow Jones? The H share represent Hong Kong shares. So I think other country can issue share in Hong Kong as well, but majority of the H share that we discussed in the capital market often come from the mainland China company who issue H shares in Hong Kong. but I guess that other country allow also to issue in Hong Kong, like in London or in Paris, and everybody can do it with some regulation to go. But the H shares represent shares issued or traded in Hong Kong Stock Exchange by a foreign company. Okay, unlike, I don't think that Prada we call H share. We just, because Prada just issue common shares in Hong Kong Stock Exchange. Okay, just only their main quarter or their headquarter of this company is located in Italy, but they don't do any cross listing, right? The H share often refer to the cross listing market that allow mainland Chinese company issue shares in Hong Kong. Okay, why they go to Hong Kong? By the way, why mainland Chinese company issue shares in Hong Kong? Yes, H shares mean they both trade in home country and Hong Kong. Why does mainland Chinese company go to Hong Kong? Because of restriction of foreign investment in mainland China. Okay, so the limit or restriction of foreign investment in mainland China. So make shares available in Hong Kong because Hong Kong is more international market where international investor can invest it freely. Okay, where if you are going to invest in mainland China, you are subject to the restriction of condition and regulation that they, you know, regulate the foreign investment. As you can see that most of the fixed rate regime, like China and Vietnam, the capital control is a key, right? It's very important. Okay, so you want to ensure to stabilize the capital flow in and out in the country. You need to well control, otherwise you're gonna be more speculation, right? And I guess in Vietnam the same. So you have a very high regulations, very strict on the foreign investment in the stock market or in capital market in general, where in Singapore, Hong Kong, Bangkok, Thailand, and those are, they are more free to do whatever you want on the capital flows, right? They're free on the capital flows. Where in Vietnam or in China, I guess in Vietnam, true, right? Can you confirm that you have you know, restriction on the foreign investment in the capital market? They try to relax in particular form, but they are still strictly control of these capital, we call capital control. Okay. Is right in China? In yes, is it right? Okay, so you understand why is you need to control, because if you let the capital flow too freely, where the government still use the fixed rate regime on the foreign exchange, the risk is much higher than the than giving the free capital flows. Which one is the best? I don't have an answer. Okay, so many even Nobel Prize winners say that China do the right policy, or Vietnam do the right policy to control, where some economists, they believe that this is not a good thing to do. We should let them to flow more freely, and that would, help. The benefits should be higher than costs, and so on and so forth. I won't go to that debate. I just want you to follow, to understand that they have different type of regime, why the regulation, the capital control need to put in place, why that affect to the risk of the country, and then we're gonna analyze it on the real practical case where you need to invest. If you are planning to invest in Vietnam, you invest in Venezuela, you invest in Thailand, what are consequences? What are how you incorporate those type of foreign exchange risk and the political risk, how we quantify those political risks, put in the figures to make a final decision whether or not you go and in what condition you go. Okay. All right. So let's come back to our business. What you can see here that the Dow Jones and emerging markets seems to have a positive correlation between the market index in emerging countries and the Dow Jones Industry Average, which is the market index of stocks listed in New York Stock Exchange. So you get some more reason. You can see that what did I put? I put the orange one, which is S&P 500, and then I put the yellow is a Shanghai Composite, and then the green one represent the emerging market MSCI emerging market index, and then you can see the brown one look the as the CAC 40. Okay, what do you observe from this graph? You can see that emerging market and the Shanghai company look more highly correlated than MSCI and the US or MSCI with the CAC 40, right? Everybody know what is CAC 40? They call the CAC 40. Everybody know what is the CAC 40? I ask you many questions because it seems like I would like to introduce you some of the discussion and try to, let you follow the discussion we have. We don't have textbook, we don't have exercise like what we have in the capital structure classes. This one we're gonna be a lot of broad discussion, but all that these are the very important vocabulary, important discussion in international context. Everybody know what is the CAC 40? Everybody know Dow Jones? If you don't know, you're dead. The CAC 40 is a benchmark French stock market index. Is a CAC, the CAC 40 is a French stock index, market index. The Dow Jones, what is the Dow Jones? What is the S&P 500? What is the Dow Jones? What is the Dow Jones? Dow Jones is the 30 top industrial stocks. Where is the Dow Jones permanent list in the US? So Dow Jones is the New York Stock Exchange Market Index. Good. I can have some simple quiz like this. NYSE, and your answer is it's a New York Stock Exchange Market Index, which is called Dow Jones. So you have Nasdaq Composite Index and S&P 500. What is it? I hope that my international finance class today or a few days we work together, I would like to bring you outside Vietnam. Go open your new eyes on international market. So all the term, all the discussion we need, hopefully it's useful for you, but go beyond Vietnam. Okay? The Dow Jones, blah, 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 is a private. D, you are the best in Google search. You go very fast and copy paste very fast. So is the exchange in New York Stock Exchange? What is the S&P 500? D, to searching. What is the S&P 500? So in capital structure class, we use it as a proxy of the market portfolios, right? So what is the S&P 500? Hello? I have seen two of you already left the class. You're tired. So maybe I give you participation class points. S&P 500. What is the S&P 500? It's a 500 largest or large company listed both in NYSE and NASDAQ. Okay, so it's a kind of US market index. Okay, that we believe that it is the well-diversified portfolio or market portfolios. Is a proxy of US market portfolios. What is a what is what is a market portfolio means? The portfolio that contain only market risk, right? When it's well diversified, we use it as a proxy of well diversified portfolios that the idiosyncratic risk had been diversified away. The people who investor who hold these US market portfolio of S&P 500 will bear only the market risk, okay, because idiosyncratic risks have been gone away from diversification benefits. And then we often refer to S&P 500 as the market portfolios. Okay, and this market portfolio contains only the market risk. All right. So what you can see here that the CAC 40 and S&P 500, even the performance is different, but you can see the shape is look like the S&P 500 and CAC 40 are positively highly correlated, where if you can see the emerging market and US market, you can see that the emerging market and the S&P 500 still positive correlated, but they are less correlated than with the CAC 40. Obviously, China, Shanghai Composite and emerging market in general, because China also part of these emerging market, you can see that they are highly correlated. So if you are able to identify if the correlation is not equal to 1, you're going to get the diversification benefits. Okay, so I think I will probably stop something here. It's a little bit about blah, blah, blah on multinational firm become more and more important. The definition of the emerging markets, okay, we often refer to the market of middle or higher income among developing countries, okay, and these are the country where we consider in emerging markets, okay, and these represent about 22 emerging countries, and the rest I will ask you to read, okay. So to have the term we call the BRIC, BRIC represent Brazil, Russia, India, China are the 4 biggest emerging country, accounting for 2/5 of the total GDP of all emerging economy. So if you take BRICS with an S, it includes the 5th largest emerging market called South Africa. Okay, so as you can see, okay, some of these important, and then we see that, you know, the capital flows from developed country to emerging countries increase dramatically. Okay, so this is a composite. Vietnam is not part of the S&P IFC composite because, as you may know, that the restriction for to foreign investor is still very strict in Vietnam. So they still categorize it in another we call frontier market, emerging frontier market. Frontier market mean the thin and a small market compared to other emerging markets. Okay. All right. So it is a kind of introduction. I would like to introduce you for today. As I told you, I will finish our class today a little bit earlier, okay? And then we don't have break so that we can finish before 3 hours. However, tomorrow we can probably have longer with short break in between. What I would like to ask you, if you can, and maybe tonight is already late in Vietnam, but if you can, please read the case. It is super interesting. If you not feel interesting, I'm gonna motivate you to make it interesting. It is super interesting, okay, to read this Petro Suhata case. Try to read the context. I'm gonna guide you for from time to time refer to the case to discuss something, and it's always very useful. Okay, like today I introduced to you that the Petro Suata is a kit of 2.4 billion US dollar project, which is a mega project that the company or the project want to issue bond in investment grade rating, and the project is located in the countries where the sovereign bond rating is lower than investment grade rating. So it's a challenge to convince that a company in the country where the country risk is higher, very high, whether or not the company in that country can get a better rating than the sovereign bond rating. It's a very interesting case, isn't it? Right? So gonna discuss why they want to go a better investment grade rating, and then what are the elements that you need to analyze. So please read the case. Is it possible you can read it this evening, or you can read it tomorrow, but the day after tomorrow, Friday, I will start talking a little bit the case every time, but the case that we're gonna talk, in a more detail would be on Friday. Okay, you still have 2 days to go to read. Is it okay? Can you read? As I told you, you can, scan, go quickly first and try to get an idea, okay? And then you believe me, you trust me, you will feel so exciting and learn a lot from reading this case. I can ask you so many questions that allow you to understand how the case get the bond, issuance in the U.S. and get the investment grade rating. Okay, the bond get the due of the year at that time, even though it's old already, but it's super interesting. Okay, so today I will stop now. I will ask you to, read the case, okay? And then I will, come back tomorrow. We're gonna talk about international parity with some problem set. We're gonna do it together. If you can do the problem set, you have time, you can do so. If you don't have time, we're gonna do it together. Okay. So, and Friday, we're gonna talk about the case more precisely. If tomorrow you can bring your calculator next to you, it's gonna be great because I'm gonna ask you to make some calculation. All right. Any questions before we go? No? Yes? Perfect. Any questions? I'm super happy to have you, to meet you one more time in this course. I know that we had done together and in the capital structure class. This class is a bit different, but I think it's still very helpful to have sessions together. It's a short module to focus on international finance issue. I hope you will enjoy, this class. Okay, and talk to you. See you tomorrow.